How's it going, everybody? Thank you for being here. My name's Antonio, and you're about to watch or listen to a conversation that is general and impersonal in nature, one that will constitute no financial advice, nor investment, nor professional advice of any sorts. This is just two guys talking who, for all you know, might be crazy or drunk or both. There is a longer warning on your screen right now, so if you don't like losing money, pause the screen and read it. That's pretty much it. All right, I'm talking to Jeff Snider here today. Finally, I was hoping to do that for a long while. So, Jeff, thank you for investing in time with me today.
Yeah, thanks for having me, Antonio. Looking forward to it.
Yeah, me as well. The pressure is all mine, obviously. And I was thinking to sort of kick it off with one of my mandatory questions here, and I'm trying to structure it because you have almost 100,000 people following you on Twitter. So my question would be, who are you, and why do you think so many people follow you?
Well, I think most people follow me because number one, what I have to say is usually very different from what you hear from everybody else. And so, from the very least, we're sort of like cats from a human perspective. That's interesting, right? This guy has something to say that I don't usually hear anywhere else. So I'm going to follow and see where it goes. Because at the end of the day, when you start thinking about some of the things I do say, even though it's contrary to the mainstream narrative, it starts to make a little bit of sense. So even if you can't dive right into the depths of all the detail and complexities, you at least start thinking, okay, I haven't heard this before, and it does make a little bit of sense. So I'm going to continue to follow along and see where this goes because it's interesting, and there does seem to be something there. Maybe I don't know what it is. Maybe I can't wrap my whole hands around it, but there does seem to be something to this story because it seems to explain a hell of a lot of not just what went on in the past, but how we got here, maybe where we're going. So it's a very comprehensive worldview, even if it's unfamiliar, even sometimes it's very dense and esoteric. It's there, and it's engaging enough that people want to follow along with it.
I can pretty much attest to that. That's sort of how I found you. I found you through a friend of mine, by the way, Menachem. Shout out to him. But so that's how I started following you, and well, I can't really sugarcoat it. And although I do watch a lot of your stuff, I still have a hard time getting the full picture. I think it's partially because I've put off understanding a lot of these concepts for a while now because, as you said in one of your recent videos, a lot of the other paths that I went on were the paths of least resistance mentally, and you sort of feel comforted, comforted,
Yeah.
comforted because you feel like you understand something. And it could be like, oh, okay, so I do understand something. These bad people over there, they're printing all that money and it's killing my purchasing power. So, well, by the way, one of those
It's
concepts.
and Tony too. Just to further that point, it's also everybody else says it, and so everybody can't be wrong, right? Because that's another part of human nature. We're hurting animals, and if everybody says this one thing, even if I think there's something wrong with it, it's very difficult to make that intellectual leap and say I'm going to go against the stream here and think on my own and think in go use my own opinions and my own assertions and my own investigation and come up with something very different because everybody, it's everybody. It's your friends, it's your neighbors, it's everything you're taught in school. We were just talking before the show, colleges, academies, they all present this other worldview, and then it's reinforced day in and day out by everything you see in the mainstream. So it's very difficult to even question, which, by the way, is sort of the point. As long as you don't question the assumptions here, it's the way it's supposed to work. And it's the whole thing is designed so that you don't really ask many questions about it. And it's much more, again, path of least resistance. It's much easier to just say, everybody says so let's just go that way.
Right. It's also, to be fair, hard to follow the other path too at times because it's just,
oh yeah,
I would get on reading and I'd be like, okay, now I'm going to read something that's really difficult or something that's not conventional, and I just not understand anything, even after reading 4 or 5 times. Bonds, one of those topics that I wanted to talk about here. There's just, I don't know, it's just hard to understand the whole dynamic of the thing, especially now that you would read stuff. I don't know if they're true or not, but there are concerns that are rising that bonds might be the new bank securities. with the government's unfunded liabilities. That's also a term that you see a lot. They're hitting new all-time highs or whatever. They're very high, and somehow they all seem to be working together. So yeah, let's maybe start there. Are bonds the most important thing in the financial system to watch right now?
Yeah, they usually are. That's a good place to start. And I know, again, if you're coming at this from a very new perspective, it's sort of difficult. And then the mainstream interpretation of what bonds are signaling is also usually very wrong. I mean, we start from the perspective of interest rates, right? And interest rates is supposed to be really simple. If interest rates go up, that means that means money's being tight. It means all sorts of, the Federal Reserve policy, as we see today, central bank policy in Europe, everywhere else. So interest rates going up must be a bad thing, and interest rates going down must be a good thing. When history shows it's usually the opposite. When interest rates go down and stay down for a prolonged period of time, that usually means money has been tight and the economy is not performing very well. So it can't be stimulus because nothing is being stimulated. Conversely, when we see periods where inflation is just absolutely out of control, nominal growth through the roof, interest rates tend to be very high, not because central banks set them that way, but because the marketplace can find all sorts of nominal opportunities that you don't want to own safe and liquid instruments. So even our basic understanding, or what we're taught about the basics of bond market and interest rates, is wrong from the very start. So again, it's easy. Everybody says this, and this is the way everybody interprets it, but the financial markets work very differently. So it's understandable why people would have a difficulty in interpreting signals, which really are fundamental to the entire global monetary, financial, and economic system.
Well, here is something that I did learn in college, because it wasn't a complete waste of time for me. At least it wasn't a waste of money, because I'm in Europe, so I got pretty much paid to go to college, so I can't really complain there. What I sort of learned is that when bond yields go up, the demand for the currency in which those bonds are denominated goes up as well, because the yields are attractive, and so vice versa. When the yields are low, demand goes down. And I also came to found an interesting conclusion. Didn't come to it myself, obviously, but I found an interesting conclusion that the country that puts off QE the longest is the country that will end up with strongest currencies, or the currency that will start declining last. Does that make any sense there?
It kind of does, but for very different reasons. Usually, if central bank is undertaking QE, it's because the system is in trouble. And the central bank isn't printing money; they don't know what else to do, so they essentially do what everybody else in the central banking community tells them to do. So if a central bank is holding off on QE, it means it's not experiencing the same amount of trouble as maybe its neighbors do. So its currency doesn't get into the same type of issues that its neighbors have. But once it finally goes into QE, the issue isn't QE, it's the reason why the central bank feels it's necessary to do a QE. And so if something's going wrong to the degree that central banks feel that they need to do QE, that's going to be reflected in the currency as well as everything else. So it's not necessarily about QE, or QE doesn't determine the direction of currency or the economy. QE is a response to what's going on that we do need to care about. It's no different in the Fed, the ECB, Bank of Japan, or anywhere else. If a central bank is doing QE, don't pay attention to the QE, pay attention to why the central bank is doing the QE. And that will then start to fill out the rest of the picture.
So it's sort of like something that just happens simultaneously with the currency going, it's somewhat of an intervention to the currency already being destroyed. Is that it?
It's sort of a correlation. It's not a causation, it's a correlation. It's a correlation because the central bank policies are reactive. They're not proactive, they're always reactive. So something bad happens, and what happens? That if it's a currency attached to the US dollar, which is pretty much everybody, then you start to see the currency drop, and you start to see central banks respond to the thing that made the currency drop. And if those two things happen relatively in the same time period, it looks like a correlation. It is a correlation, but some people interpret it as causation.
All right.
That has happened repeatedly. People mistake this correlation for causation when in fact central banks are reacting to the thing that you really need to pay attention to. But we focus on central banks because of course we do. It's in the media, it's in the news, it's in everything that we're taught. And so, you see the Fed's balance sheet go up, you see the ECB's balance sheet swell, and you think, that must be the cause of everything we're seeing, especially when it seems consistent when currencies are dropping. But that's just simple correlation. And again, central bank policies are reactive, which means they're reacting to something that has happened that has caused both the central bank policy as well as the consequences in the economic, financial, and monetary system.
What do you think the central bank, in the face of the Fed, obviously in the US, what do you think they're worried about right now? Is it a currency? Are they thinking about how to save it? Do they care about the economy as a whole? Do they, I don't care about the stock market or the housing market? And I'm just guessing at this point, but what do you think they care about right now?
Yeah, I think they care about phone calls from the White House. I think the Fed is under enormous political pressure to appear to be doing something about consumer prices that by its own standards and its own admission, it can't have any rate hikes are not going to solve consumer prices. The economy is already doing that. But the Fed, like the ECB, has enormous political pressures to try to, I mean, in the US, we have an election coming up in less than a month. And so enormous political pressure to appear to be doing something substantial about what is the number one issue for most voters in the US. I assume it's probably even more of an issue for voters in Europe and other places around the world. So the Fed is simply reacting to the political optics of CPIs going at, stubborn CPIs that stick around 40-year highs are no good. I mean, people hear that all the time. They can feel it, whatever else. So what is the Fed going to do about it, though? I mean, what are rate hikes going to do about getting more oil out of the ground or, getting shipping, especially railroads in the United States, untangling some of these logistical supply chains? They're not. I mean, there's never been a realistic situation. I like what Christine Lagarde said earlier this year when someone asked her about the same thing. Are you going to follow the Fed's path? And she said, hell no. Why would we? We're not going to get more oil out of the ground with rate hikes. And of course, she turned around 180 degrees in the opposite direction a few months later. Why? Not because consumer prices or inflation's out of control, but because she's being politically pressured by governments all over Europe. So what central banks are doing, they're doing it for non-economic reasons. They're not doing it because this is an out of control inflation. They're doing it because CPIs are high and they don't know what else to do. They don't know how to solve what is a non-economic problem. They can't solve what is a non-economic problem.
Yeah, and it's also sort of, at least that's how we did a field trip one day with college where you go to a money museum and then you get to control the lever of when the economy is slowing down, you get to raise interest rates or lower interest rates. And I think there was only one lever there, and that's pretty much the only thing you could do. And then you always mess it up. That was the point, to show you that you're not really smarter than the central bank. And so, you raise the rates too much, and then everybody's out of job and stuff like that. So that was also
but see that Turner, that's part of the myth and the legend. We believe that directions in the economy are influenced, or if not controlled, by central banks. And that's just the myth that's been constructed ever since Paul Volcker in the United States, going back 40 years. When the truth is, interest rates don't work that way, and central banks don't have that level of control and influence. Why are consumer prices so out of control, or at least appear to be so out of control? I mean, in Europe, you know exactly why. Yeah. You have the politics of oil and energy. It has nothing to do with money printing. There's nothing to do with economy. It's the fact that supply and demand are in such a massive mismatch that prices can only be high. That's the only way to adjust a very simple economic imbalance. And it's true about not just oil and energy, but food and all sorts of other goods too. More broadly speaking, around the world, you had the recovery the rebound from the COVID recession in 2020. Demand came back much faster than supply could service it. Again, simple economics. When demand rate rises or rebounds faster than supply, the only way to adjust is through prices. That had nothing to do with money printing. It wasn't even really economic. It's all about, shipping. It's all about pandemic policies, snags in the labor market, shortages, all sorts of non-economic issues that rate hikes are not going to influence, rate hikes are not going to solve. And so we have this mismatch where central banks are doing things that are counterproductive at best, and probably more likely irrelevant than not.
Could we make the case for stagflation, though? Because if interest rates are going up and they cause more unemployment, but the problem with inflation is already in the supply chain, if you have staff shortages, you're going to have more supply chain issues, which might cause the prices to go up even more, and then what you have is lower economic growth, but then higher prices. Is that a possibility?
No, I don't think so, because what ends up happening is the classic supply shock case, which the downside is simply when you get into the demand destruction component, which I think we've been in pretty much all year, that takes care of the high prices. So in essence, you have demand shift to the right, which means demand goes up far more than supply is able to service. It causes essentially a massive redistribution in the economy that the economy cannot afford. I mean, we can't afford gasoline and food prices where they are and where they're going to be, which means that you're essentially robbing from the more vital parts of the economy to pay for non-productive uses like higher gasoline and higher food, which eventually destroys demand in the more productive parts. And so demand starts to come back down for the same level of supply, which means prices normalize anyway. So you don't get stuck into this feedback loop. There is no secular inflation. And that's another misconception too. People don't understand what inflation is as well. As Milton Friedman said a long time ago, 60 years ago, almost 60 years ago, real inflation is always and everywhere a monetary phenomenon. And so people have, again, correlated what central banks have done with consumer prices since 2020 and said, there's the money printing. The Fed has printed money. The ECB has printed money, and now it's showing up in consumer prices. But they said the same thing more than a decade ago. In 2008 and 2009 in particular, when the Fed did its first QE, they said, oh my God, the money printing, it's going to lead the dollar to crash. It's going to lead consumer prices to explode. And those things never happened. So what changed in 2020? Was it the quote unquote money printing by the Fed, or was it the supply and demand dynamics of the COVID pandemic responses? It was obviously the latter. And if it is a supply shock, the latter, that explains consumer price. That's not inflation. It's not going to turn into some secular inflationary bubble like the 1970s, because the money has not been printed. And that's really the hardest intellectual leap to get people to make, because they're saying, what do you mean it hasn't been printed? I see the Fed's balance sheet. I see the ECB's balance sheet. There's trillions of bank reserves that didn't used to be there. And that gets into the broader discussion about what actually money is in the system. What is the monetary system that we actually use as a reserve currency system? And those things are nothing like what they teach you in the textbook.
You also see charts like the M2 money supply, for example. That's one that's used a lot. And you see that spiking.
Yep.
And that's the money that's in circulation. I mean, that's how I understand it. That's the money that's in circulation. So there's a lot more money out there.
That's again, the misconceptions. M1, M2, M3, all of those are obsolete and outdated a long, long time ago. And the fact the Fed knows this. The Fed was talking about M1 and M2 being obsolete in the 1970s, 50 years ago, because M1 and M2 were obsolete in the 1970s. M2 is nothing more than a smaller subset of what we can define of a much larger monetary picture that spans the globe. That is what this Eurodollar story I always talk about actually means, is that the monetary system was defined in the old days by M1 and M2. It actually wasn't, but by the time we got to the 1960s, we started to define money supply as checkable accounts, transaction levels of money, and then they got into the depository money of M2. And those are, first of all, those are only domestic U.S. domestic statistics, or the domestic European statistics if you're looking at the euro area. So they're just a smaller subset of what banks had been doing, experimenting with different monetary forms throughout the 1950s into the 1960s, so that by the 1970s, you had this massive monetary system outside the United States that could not fit into either M1 or M2. So the Federal Reserve had all of these discussions in the 1970s saying, we can't define what actually encompasses useful money across the globe. Remember, the US dollar denomination is supposed to be the reserve currency. It's actually the Eurodollar, but US dollar denomination is the reserve currency, which means it affects everybody. Yeah. The US dollar is on the other side of nearly every foreign transaction that takes place, even today. So we have this massive monetary system that has nothing to do with physical Federal Reserve notes or even bank reserves that the Fed creates. It's an encompassing, self-contained, reserveless monetary system. And because of that, M1 and M2 don't define what's actually used in money around the world. In fact, they're a very small subset.
How much of it do you think it is?
I'm sorry?
How much of it do you think it is? Like if you look at M2 relative to all the money that could be out there, we don't really know, right? We don't even have a way to count it.
Exactly. That's the problem right there. We have no freaking idea, but we do know it's unbelievably huge.
Is it
and
a
then the other
10th?
part of this too, Antonio, is that the lines between money and credit have blurred. Some forms of credit are used in a monetary fashion. So it's the amount of money that's usable as money in the global economy is much, much bigger than M2. I can't give you a number, can't give you an estimate because we have no freaking idea. And I've been looking at this stuff for a quarter century. I wouldn't even venture a guess. Just to give you an example, in 2017, the BIS finally started to take a closer look at the offshore US dollar transactions. And they looked at essentially footnotes of banks' balance sheets, because that's where you really have to go to find this money. It's in bank balance sheets footnotes, not on their balance sheets. It's all in the notes in the bottom. What they found was there's about 15 or 16 trillion in US dollar denominated derivative transactions that function equivalently as money and credit. But those don't show up in any statistics anywhere. They're just in the footnotes of these major banks. So currency swaps, currency derivatives function like money, but where do you put that in M2? You can't. So when people say M2 has gone way up, that's absolutely true. But that's only a small, narrow part of what the overall monetary picture must be. And so it very well could be, as was the case in 2008. People forget that M2, it didn't spike in the same degree it did in 2020, but M2 went way up. I think it was about 6 or 8% in September and October 2008. During the worst monetary crisis since the Great Depression, M2 went up. Why? Because banks that were doing stuff and all this shadow money that was being destroyed were forced into liquidity backstops and other things that showed up in the M2 statistics. So you have M2 going up because it's a small subset, while the shadow money you can't see was being destroyed. And the shadow money that you can't see being destroyed was the worst monetary panic since the Great Depression. So you see the Fed's balance sheet go way up, but yet you're like, well, how can the Fed be printing money if we're having a worldwide monetary panic? And the reason is because the Fed doesn't matter. The M2 is only a small slice of the overall whole. And the stuff that you can't see, that you know must be happening because we see this panic, we see markets getting crushed, we see banks getting crushed. We know there's a monetary disruption, even though we can't define it, we can't measure it, we can't really monitor it. We know it's happening because of what's going on in the world. And what's going on in the world, as I said before, is usually the exact opposite of what the Federal Reserve is doing. So when you see the Fed doing a lot of stuff, that usually means that's because the shadow money is being destroyed, that it's forcing the Fed into action. That's why you get these curious correlations.
If we assume that M2 is one of the 10 slices of all the money that's out there, and you see that M2 has doubled over the last 2 years, then essentially what happened is that, you have one slice added to the 10, so that's only a 10% increase. Which changes your whole perspective of thinking, oh, but we have twice as much currency out there that has to be soaked up by some assets, and it gets soaked up by consumer prices and asset prices, and that's why you get CPI and API going up. But it's just not, it's not as much.
Just simple transfers too. For example, when M2 went up in 2020, most of it was because they just redefined M1. So you have M1 money becoming M2. And it could be that you have some of the shadow money that's just being transferred into a more visible form, which is a domestic depository format. So you have banks that used to be settling everything in repo, which doesn't show up in any of the numbers. It used to be an M3. Part of it was an M3. So you have banks doing less settlement in repo, more settlement using checkable deposits. It looks like M2 is going up, and it's really shadow money is going down and being transferred into M2. So M2 is a very incomplete statistic, which is why you can't rely. Again, going back to the 1970s, the Fed said we can't rely on these numbers. And because of that, that's how we got into this paradigm to begin with. By the end of the 1970s, the Fed and economists said, we can't define money. One of the quotes I use all the time from I think it was 1980, maybe 1981, one of the Federal Reserve members said, we have no way of tracking transaction money, and I don't think we ever will. And he was absolutely right. Here we are 40 years later. We have no idea how to track transaction balances in the economy. As I said, the BIS in 2017 15, 16 trillion in currency derivatives that function like transaction forms of money. So what do you do if you're a central bank and you can't track it, you can't define it, you can't monitor it, you can't regulate it? That's the other thing. This stuff takes place outside the United States. That's what EuroDollar actually means. It doesn't really mean Europe. It means offshore. It's dollars that are transacted and created and moved around and redistributed outside the United States. So already you're outside the reach of what's supposed to be the central bank, right? The Fed's legal authority stops at the U.S. boundary, but these U.S. dollars don't. These U.S. dollars circulate widely throughout the rest of the world. So if you're the Fed, you've got money you can't define or track or monitor, and most of it is outside the United States. What the hell do you do? First of all, nobody's ever heard this. And second of all, what we believe happened was Paul Volcker raised and lowered the federal funds rate, and therefore that was enough of a monetary control. Essentially, the Fed said, we can't define money, but if we target a federal funds rate, that's enough to influence enough economic and financial behavior. We don't have to track money. We'll just try to raise and lower the federal funds rate and hope, fingers crossed, that nothing bad happens. And that's what we've all been led to believe has happened, that because of the 90s and 2000s, this quote unquote great moderation, the Federal Reserve doesn't even need to know anything about money because it can influence psychology and behavior sufficiently to control the economy and finance. Of course, it's ridiculous. The whole notion is stupid. And that's how you end up with something like 2007 and 2008, because when you have an actual monetary panic, but you don't have a central bank, you have what's pretending to be a central bank that only targets an interest rate, you have a very big problem, which is why throughout that crisis period, everything the Fed did failed. The crisis wasn't in September and October 2008. It began in early 2007, and it only escalated time after time after time. By the time you get to August of 2007, it was too late. And the Fed responded with the same things that it always responds to, which is moving interest rates around. It had absolutely no effect on the crisis, because why would it? So you have a monetary system that doesn't operate with the Fed as really part of it at all. Bank reserves don't really have a place in it, but that's all the Fed has, and that's all the Fed does. So 2008 makes sense. So does the cries in 2009 where the Fed is printing money and it's going to lead to inflation. Well, why didn't it? Because the money you didn't see was not inflationary. In fact, it was deflationary, disinflationary throughout the entire period up until 2020. So every time everybody said the Fed is printing money, no, the Fed wasn't printing money. It was responding to the deflationary destruction of money that nobody could see and observe.
There's also this, I wrote this down because you brought up the EuroDollar. There's this general belief that when commodities, especially now oil, natural gas, and also food commodities, when they're rising in price, the dollar cannot be running. But someone I spoke to, Menachem, by the way, I mentioned it's a friend of mine that actually introduced me to you. He brought up an interesting point that maybe in a world where the majority of the commodity buying happens in the US dollar, in the euro dollars, what it gets used to make the majority of the buying happen, higher commodity prices could actually result in more demand for the US dollar. Do you think that claim is valid? Does that make sense to you?
It is, and it is in a sense. We've seen this in the 1970s too. It's tricky. The terminology is a little bit tricky, but yeah, I think overall what happens is it leads to redistribution. So demand for dollars shifts from certain places, as does the flow of dollars. Think about it from the perspective of an oil producer. An oil producer, when you get into the supply situation where prices go up, it's good to be an oil producer, right? Because now all of a sudden you're going to have more dollars coming in than you are spending dollars for whatever imports or financial flows that you're experiencing. So it's net positive for oil producers, but yet it becomes net negative for large oil importers. So like India, for example, or Japan. Japan's a perfect, maybe even better example, where they have to import nearly all of their energy and food consumption needs. India is more energy than food. And what ends up happening? They lose dollars. They lose lots of dollars. In fact, that's one of the primary symptoms that we see of a dollar shortage, is that reserves, national reserves for these various places go down. because the Eurodollar system is not replenishing. It's not lending to these countries so that they can pay higher prices for these commodities. And so they left with fewer and fewer dollars. And as more and more dollars leave those countries, what happens to their currencies? The currencies reflect the dollar and currency imbalances. So you see the Indian rupee fall to a record low. You see the Japanese yen fall to a 20-year low. You see the British pound get pounded. You see all these currencies around the world that are reflecting these very different monetary fundamentals. So from the perspective of commodity producers, high commodity prices. If they were experiencing a dollar problem before, as several Middle East countries were after 2018 and 2019, you don't hear much about them these days because they're on the good end of Eurodollar redistributions.
I'm thinking, how come that's happening to those currencies? Because what you mentioned earlier about most of the money, actually most of the dollars that are created don't even get created within the US. But even when they do get created in the US, they get created in the commercial banking system. So when a bank is giving out a loan, that the money springs into existence pretty much out of nowhere. But if commercial banks, foreign commercial banks, if they have the power to do that, why wouldn't their foreign governments, why wouldn't they just push the commercial banks to create more dollar denominated loans in order for just there to be more dollars and their companies to be able to pay for those more expensive commodities now in those dollars? Why is that not happening?
Why aren't banks lending more? Essentially, the answer is internal constraints. And among those internal constraints, because theoretically think, okay, what is the Eurodollar system itself? There is no currency. There's no Federal Reserve notes. There's really no central bank here. So essentially, it's a distributed ledger. It's a virtual currency. It's a fictive currency. It's a money of account. And that kind of technology people are starting to run across with cryptocurrencies is actually very old. Ledger money goes back to 15th, 14th century. Essentially, you just have an acceptable group of people. Acceptable is probably the wrong term because it's the global banks that we've empowered to keep track of who owes what. That's really all it is. It's a distributed ledger where banks say, I have a group of book entries that tell me who I owe cash to, but nobody ever uses the cash. So essentially, it's claims on cash that the claims on cash become actual money. So there is no physical currency. There's no attachment to U.S. currency supply or the Federal Reserve. So then you think, well, then isn't money, if this is just ledger money, isn't it theoretically unlimited? Because banks can just create claims left. I mean, right? They can just make them. It's, as you said before, the bookkeeper's pen. Another phrase from Milton Friedman. Essentially, that banks can create money at their whim. So why don't they just do that? Why don't they just create all the money in the world? Because we have, as you know, Antonio, accounting standards. We have internal constraints. So banks, theoretically, ledger money could be unlimited, but it's really not. It's constrained by the individual balance sheet governance rules by which individual firms are using for themselves. And among the biggest of those is volatility correlation, some of the more complicated mathematical properties of financial markets and assumptions. So if you're a bank and your balance sheet is operating, let's just use volatility because it's an easy one. Higher volatility means you can't create more money or credits because expected losses go up, right? Because that's what volatility essentially means. Higher probability that you'll lose money making a loan. And again, we're not losing actual physical money. It's just book entries on a bank's balance sheet. But there are very real consequences to this book entry ledger money system. Just ask Bear Stearns, Lehman Brothers, or any of those nationalized banks throughout Europe. So this accounting becomes very real when it goes in the wrong direction, when it goes astray. And so if volatility goes up or expected losses go up for whatever reasons, you have to scale back on the amount of money and credit that you're able to create. And so if you're looking at Japan, for example, you're going to say any loan I make in dollars to Japan, or any currency swap or basis swap that I want to make to Japan, I have to charge a huge premium just to be compensated for the enormous risks that are involved in doing so. So even though we're not exchanging actual cash, we're exchanging cash flows, I'm going to charge you a huge premium, which gets reflected in a number of things, not just interest rates, but also the fall in currency on the other side of the swap. And so that's what really restrains banks from just creating money out of thin air to pay for all these things, because eventually it has to go on a balance sheet and an income statement. And if there are losses that go through the income statement, that has very real ramifications for the institution, as we saw in the 2008 crisis. So volatility and correlation, those kill money creation more than anything there else out there. And if you're looking at some of these the countries around the world that are experiencing high import drains, those are huge risks that you just can't take without charging a huge premium. And so you can't. That's why banks aren't lending to make up the monetary deficits, because they're looking at India, they're looking at New Zealand and other countries around the world that are at the wrong end of these redistribution and saying it's just too risky, can't do it.
Part of the reserve requirements, or I think completely, were waived by the Fed, right? And I was thinking if you maybe think that had anything to do with them anticipating more supply of treasuries that were going to be soaked up because commercial banks could create more loans without reserve requirements. Do you think that happened?
Well, yeah, there's a couple of different things. Reserve requirements go back to actual physical currency. What the Federal Reserve did in 2020 when it reclassified M1 and M2 was essentially say that nobody uses currency. And that's been true for over a century. I think that's another thing that people don't realize. Just the monetary fundamentals that we all get wrong, essentially, is basically all of them. When you ask somebody what is money, chances are they're going to reach in their pocket, if they have a physical piece of paper that has a government's logo and everything on it, they say that's money. But hand-to-hand currency like that hasn't been used in any substantial proportion in any modern economic system since maybe the 1910s or 1920s. We've been on a ledger money system for over a century, yet nobody realizes. Nobody stops and thinks about it. So physical currency is about reserve requirements are about physical currency. That was one of the problems in the 1930s, was that people converted their paper ledger money liabilities into physical cash because they were afraid of the banking system. Well, we went through a 2008 crisis that was in every way a bank run, but nobody converted their liabilities into physical cash, because physical cash, you don't use it. What ended up happening was you had banks panicking, not the public. So there is no use for physical cash, not really, not in any meaningful sense. So what the Fed did in 2020 was say, we don't need reserve requirements because nobody uses cash. And the more we go in the direction of electronics, the less cash gets used as it is. You talk to people who work in the banking system, the only cash that anybody ever used was from ATMs. And even ATM use has gone way off the charts. I mean, it's fallen through the floor. There is no use for physical cash, so there's no use for reserve requirements. Now, as far as the other issue about treasuries and balance sheet constraints, there's a couple regulations that banks do have to pay attention to. Basel III rules, like that basically reflect the size of their balance sheet and how much of a government charge, the SLR, that the governments are going to impose upon capital constraints, and some of the balance sheet numbers that banks use to balance their liabilities and assets. What the Fed did was say, if you buy a bunch of U.S. treasuries or you get a bunch of bank reserves from the Fed, we're not going to count those for the first initial crisis period against your balance sheet regulatory requirements, because we want you to buy a bunch of treasuries. We want you to hold a lot of bank reserves. We want you to be very liquid. And so for the first year, a little bit over a year, they essentially removed the SLR requirement for buying treasuries and holding bank reserves. But then they reimposed that last year, and it didn't lead to a crash in the treasury market. It didn't lead to any major problems because banks were only too willing to own safe and liquid assets, which gets back to what we originally talked about, low interest rates. If banks are willing to own safe and liquid assets, and only safe and liquid assets, what does that tell you about their perception of safety and liquidity? So when treasury rates go down or are down compared to other rates, such as short-term rates at the Fed, that means safety and liquidity are being prioritized in an unusual way. And so low rates are a sign of tight money or lack of safety and lack of liquidity. And that's what we've seen in the yield curve and curves around Europe and all over the place that are inverted. They're telling us the demand for safe and liquid assets are in high demand. And that goes along with all these other things that we're seeing with, currencies falling, reserves leaving from foreign countries around the world. It's all telling us that we're in this tight money regime, which is contrary to inflation.
Didn't volatility in the bond market go like massively down or something though?
Well, volatility in the bond market's gone up because of the Fed pushing on the short end of the yield curve, and the ECB to that in that respect too. But there's other mechanics that are involved. But so you look at the short end of the yield curve, which is influenced by the Fed and its various alternatives like the RRP or IOER, and that short end of the euro curve, short end of the Eurodollar futures curve, any money alternative is going to be influenced by the Fed's alternatives. Then you go further down the curve into middle and longer term treasuries and bonds that are more influenced by perceptions of safety and liquidity over the intermediate and longer term, which means the bond curves behave independently from the Federal Reserve, which is why right now the U.S. Treasury yield curve is more inverted than it's been in, I think, 3 or 4 recessions, because demand for safety and liquidity that far down the curve away from the Federal Reserve influence is through the roof. And of course, it's through the roof because we see all of these warning signs, not just in markets, but events. I mean, what happened in the UK was less about the UK than people think. We've got dollar swaps being accessed in Switzerland now. I mean, there's all sorts of signs that money in the Eurodollar money is exceedingly tight, and it's causing enormous problems around the world.
So you don't think there's the danger of monetary oversupply has increased over the last 2 years?
Not at all. I think it's still the opposite.
And
you see that in most of the statistics. When you actually look at the data, you don't see a sharp spike in, I mean, yes, M2, but everything else that tells us about the monetary system outside of M2, you never saw a sharp rise in yield curve. Again, if there had been actual monetary inflation, the real stuff of inflation, you would have seen the yield curve steepen long before it actually happened, as we saw in the 1960s into the 1970s. Long-term interest rates and yield curve spreads went higher, anticipating the inflation that continued for 15 years, when we actually had flattening happen since the middle of last year. And then it obviously curve inversions once central banks started to raise rates.
I'm trying to remember, but I watched something. I don't remember who it was from. I wish I did, to give them credit, but there's something about the yield curve maybe not mattering as much anymore. Yep. Was it Ken Fisher? Yeah, Ken Fisher.
There's tons of central bankers say the same thing. And of course they say that because, first of all, the reason they say it is because, hey, didn't the Fed buy a bunch of bonds? So if the Fed's buying a bunch of bonds, aren't low rates just a reflection of the Fed buying bonds? Therefore, we can't pay attention to bonds because the Fed bought a bunch of bonds, or the ECB, right? They've spoiled the signal, essentially what these people are saying, which conveniently happens to be a signal that tells everybody the Fed's useless. So of course they're going to say that spoiled the signal. But here's the thing. If the Fed bought a bunch of bonds, it should be easy for us to tell how much of an effect that had on bond yields. And you don't want to trust my verdict or my judgment on it? Fine. As I say with all of these things, you never have to take my word for it. There's always an official source that tells you exactly what I'm telling you. So you look at any number of the academic studies on quantitative easing or quantitative tightening, what you find is that even central bank sponsored authors can find no very real effect. Central bank bond buying does not impact bond yields by all that much, if at all. And even all you really need to do is hold up a chart. Look at a chart of U.S. Treasury yields versus when the Fed is buying bonds, and you'll see zero correlation at best. And most times there's an inverse correlation. For example, in 2019, the Fed was doing quantitative tightening, and in the first part of 2018, that kind of made sense. But then bond yields started to fall precipitously starting in late 2018 into 2019, even though the Fed was doing QT, not QE, QT. So why weren't bond yields going up if the Fed is reducing its balance sheet? It went in the opposite direction. And so there really is no correlation between what the Fed's bond purchasing programs are doing and what interest rates are doing. And so from the mainstream academic perspective of QE, you find almost no impact of QE on yields because The market determines yield, not central banks. But this is another myth that persists, that everybody holds, because you think the Fed bought all these bonds, how can it not have an effect? And the reason is because the market has the effect before the Fed does it. It's always correlation. The market starts to buy safe liquid instruments, and then the Fed comes in because of the reason the market's buying safe and liquid, right? If we have a deflationary tight money situation that leads the market into buying safe and liquid investments, that also provokes the Fed to doing what the Fed does. We have a deflationary situation. What does the Fed do? It always does QE because that's the only thing the Fed can do. So the market starts buying bonds because deflationary situation. The Fed starts buying bonds because deflationary situation. Yet everybody believes that bond yields go down because the Fed is buying bonds. It really is that ridiculous.
I was thinking more about in the lines of the yields curve predicting powers for an inflation, because I guess the point was that back in the day, banks used to get money based on one side of the yield curve, and they had to pay for money based on the other end of the yield curve, if that makes sense.
Maturity transformation.
Yeah, exactly. So I think so. What it came down to is that on basically, if the yield curve inverts, that means that it's too expensive for banks to take on deposits and make out new loans. But we don't have the reserve requirements anymore, so that's why maybe the yield curve doesn't matter as much.
Yeah, and that's also an archaic view of the banking system. I mean, that's not really relevant to the 21st century. It isn't relevant to the second half of the 20th century, which is what Volcker found out at the end of the 1970s. That's not how banking works. I mean, we're in a system where we're talking about basis swaps and derivative swaps, not deposits, something like that. So the funding cost that you think in maturity transformation, that's not how banking actually works. And so you're applying a 1930s view of 2020s and saying that the yield curve, we can ignore the yield curve signal because this is what some textbook said about 50, 70, 80, 90 years ago. All these mainstream explanations begin from at best an outdated worldview, and they don't encompass what actually happens. They don't tell us what actually happens in terms of the details of the monetary and financial system, which is why they always end up trying to say something like the yield curve, we can just ignore it. The inversion, we can just ignore it because it's telling something that is the opposite of what I'm trying to tell people, right? It's really convenient how that always happens.
Mm-hmm. I'm thinking about how to wrap this sort of up, because I know you got to go in 5 or 6 minutes. Maybe an interesting way to end it up could be talking about what you think a perfect monetary system would look like. Like how would you? I came across some good explanations from Professor Richard Werner, whatever, who claims that having many small banks is much more productive for the economy, and it also immediately eliminates the danger of monetary oversupply. So is that something along the lines of what you would say a perfect monetary system looks like, or how do you see it?
Yeah, I mean, perfect. First of all, I think the idea of a perfect monetary system is impossible, right? I mean, we live in an imperfect world, for lack of a better term. So just very big picture stuff. Where the Eurodollar went wrong, well, it went wrong in a couple of different places, but essentially it combined the functions of intermediation and monetary creation. Because it's a reserveless ledger money system, that means it depends upon bank balance sheets to expand, which means banks are in charge of money creation, money and credit creation. That's what they do, not the Fed. It's what commercial banks do around the world. However, commercial banks are also supposed to perform the role of intermediation, which is basically a very fundamental, necessary component of a modern monetary system and financial system, which means they're not supposed to give loan, like subprime mortgages, for example. That would, in any functioning intermediation system, that would have been absolutely crazy. Nobody ever would have done that, because you would say the risks of doing of lending in such size and such scale to people we know are not going to be able to pay it back is just insane. So you have banks, the intermediation function that is supposed to be about productivity and efficiency. But when you combine common sense, when you combine money creation with intermediation, what happens is you start to focus on money creation, and you focus less on intermediation. So banks became money creators and less intermediation. So that's how you get to the situation where you have money created willy-nilly spread all over the world. It wasn't just in the US housing bubble. We had corporate credit explode all over the place. So any monetary system that hopefully evolves from this bad situation that we've been in since August of 2007 will separate those functions out. And the idea of small banks that are not really money creators, but are more intermediaries, certainly could be a possibility. But the big picture, and of course, I'm oversimplifying and not really being too nuanced here, but separating the functions of intermediation from money creation would be a good place to start, just in terms of conceptualization and thinking about these problems.
I'm trying to be respectful here of your time. So before we get to a better monetary system, because as you said, perfect, not really possible. Do you think we'll have to go through a global default? Do we see hyperinflation, recession, depression, or what would your sort of step-by-step maybe outlook on how things will play out be?
Well, we've already been in a depression for the last 15 years, which again, most people don't even realize it because they think, well, GDP is at record highs, unemployment rates are low, central banks have printed money, how could we be in depression? And if you look at the actual statistics, you can see that what happened was in 2008, the monetary crisis, the entire global trajectory changed. So yes, GDP is still growing, but it's growing at nowhere near the same rates as it did before the crisis. And we live in a nonlinear world, which means if you used to grow at 10% and you're only growing at 5%, that's an enormous contraction, especially spread out over time. And that's really the reason why we see so much problems around the world, social, political, outside of the economy and finance, is because people don't realize the economy was broken 15 years ago. The monetary system broke down and it has never been fixed. So we've already been living with a decade and a half of deflationary, depressionary consequences, and nobody has a freaking clue that this has happened. And central banks and governments have no incentive to tell them the truth, right? Because then you would say, wait a minute, why didn't you fix this stuff 15 years ago? All you've been doing is one QE after another. Maybe this QE stuff doesn't work. Maybe this QE stuff isn't what everybody believes. They're never going to say that. They're going to perpetuate the myth that they've been printing money, the economy's fine, everybody's good. But all you got to do is get out a GDP chart and track trends. And you will see that the trend of economic growth in the United States, Europe, emerging markets, Russia, everywhere around the world changed in 2008, and it has never been the same since. QE doesn't work. There wasn't any money printing. And so the consequences, Antonio, are huge because we've already 15 years into a depression that nobody knows, which is why my friend and former colleague, Emil Kalinowski, calls it the silent depression. It has happened and nobody knows it because everybody thinks that we have too much money, the economies are doing well, and all these other myths and legends that nobody bothers to check any of these assumptions. And so the question becomes, how do we go from what we have now, which is way too far into a depression, to something that can actually solve it? And it doesn't necessarily have to be an enormous crash. It could be something positive. The Eurodollar system itself arose in the 1950s. Nobody knew it happened to solve a very big and intractable problem, Triffin's paradox. The Eurodollar system had solved that problem before anybody even realized it was much of a problem. So how do we get out of this rut and into a paradigm of actual growth and recovery? I think we just need to solve the monetary problems that actually exist, which is it's a complicated issue and a complicated topic. But there are definite ways to do it. But step one has to be realizing what actually has happened over the last 70 years. And that's an enormous thing. It's an enormous task to get people to even think. Everything that I thought about money and central banking and credit and QE and bank reserves and everything else, that stuff is all wrong. When you present it to most people, it's just too much of an intellectual leap to make, which is why I always say, look at the data, see for yourself. Don't take my word for it. There's tons of studies on QE. There's tons of primary source material on the Eurodollar and how money actually works, if you actually know where to find it. Central bankers admit throughout history, the last 40 years, we don't do money. That's not our job. We don't know how. All this stuff is out there. It's just nobody has ever really put it together because there's no incentive to do that.
Well, it's also hard for me to maybe understand or believe that, because if I look around myself, I don't really see depression. I see prosperity. Streets are getting better. We got better cars, more money. We eat well. I mean, this feels nowhere near what 1929 was, or something along those lines.
I
So
think,
how
yeah,
can
but
we be in depression?
that's the misconception, right? Because when you use the word depression, everybody immediately thinks 1930.
Yeah.
That's not necessarily what depression means.
Hmm.
So if you have growth in living standards rising at a certain rate, and then they still rise, but they rise at a much lesser rate, you may not notice, you may not be consciously aware of that change, but you'll notice it, you'll feel it.
Also, you mean that the difference between my parents and their grandparents was much larger than the differences is between my parents and my kids.
Yes.
I don't have
And
kids, but
you will notice that. Yeah. And you'll see it because, our grandparents went from an analog world to a digital world, which seems like a miracle. And it really was. That's the level of prosperity that you're talking about. But if your kids look back and say, we're still at this kind of the same digital world, things are a little bit better, but they're not radically better like they were for you guys, you'll notice that. And that's the level of economic activity that has fallen off. And over the last 15 years, you can start to see it. You can start to sense it. Why are we still on the same version of iPhones? They haven't really changed much over the last little while. And that's sort of a simplistic example, but by and large, that's the big picture issue here. Is that economic growth has fallen way off. And you and I don't notice it as much because we live in the US and Europe, but I guarantee you people around the rest of the world can feel it already. You look at places like Brazil, for example, their economy experienced a massive monetary contraction in 2014 and 2015, which they've never come back from. So yeah, they're feeling the depression. They're feeling it as many places around the rest of the world that aren't as sheltered as we are. But even where we are, you can feel the lack of progress, even though, as you said, we're not going to define depression in the same way we did in the 1930s, but that doesn't mean that we haven't lived through one.
I don't know, Jeff. Even though I haven't installed TikTok on my phone, I see a lot of people having fun with it. So that's a good technological development.
I'm not sure that it is either. It's good for the Chinese, I think.
It's true. Jeff, this has been great. Thank you for investing your time in me or wasting it on me, but I appreciate you sitting down with me.
My pleasure. Always happy to do so.